Hello, good evening, everyone. So, welcome to uSMART sharing sessions. So, first of all, thanks for your coming to these sharing sessions. And today's topic will be talking about sell options. So, you need to have an basics idea about this option trading. So, for the last week, I talked about buy side of the options. Today I will talk about sell side of the options. So I hope you all can learn something here today. And if you all got any friends or families that are interested in this selling options trading strategy, maybe you all can invite your friends to these free uSMART lessons. So I think that we will wait for another 3 minutes. So please be patient, and if got any questions, please don't hesitate to leave down the questions, and I will try my best to reply you all. All right. So in investment or trading, we are always learning. Till now, I'm also still learning. So let's us learn together, and I hope everyone can benefit from these sessions and then can excel in trading or investing. So another 1 minute to go, and I will start on 8 p.m. mark. All right, times is up. Okay, so as usual, I will start by introducing myself. My name is Ming. I'm from Malaysia. So for the past 7 years, I've been become a full-time trader. I trade forex, crypto, share markets, and also do automated trading strategies like using grid trading to get a fairly consistent profits in different types of trades. So now I ventured into this education field, and I hope that I can uh, share some of my experience with you all. So today I will be talking about this option selling. So for the last week, I've been sharing to to the users about buy options, buy call, or buy puts. So today I will be talking about sell call and also sell puts. So if you all don't have any basics, it's okay. I will try to go through the basics of the options, and then I will try to make these strategies like ideas about selling options very easy. So many people think that like trading options is um, very complicated. However, for me, I don't think so. I'll try to make it easy. And then if you all did have any questions, please don't hesitate to leave down in the comment sections. All right, so let's go. So today we will be talking about beginners trading guides, like how we will learn about option selling. How can we sell sell options and then generates the passive income. This is the idea of these sharing sessions. So here is the disclaimer. So everything I share with you all later is all about this for education purpose only. So this is not any buy call or sell call. It's just a reference for your as a education's purpose. So let us start from basics again. So what is options? So this is the theory behind what is options. Options are contracts that grant you the right but not the obligations to buy or sell an asset at a specific price on or before a specific date. So options actually give you the right to buy or not if you are on the buy call side. If you are on the buy sell side, you have the right to sell. So this is just a basic ideas. So for those who don't really understand these basics, maybe you all can look back at the replay in the apps, or make sure you all follow uSMART every month options basics trading sessions. So options actually is like booking a property. If you book a property, you have to give the deposit, right? So in options, the deposit acts as a premium. And then if we do a buy call, if in options, if we do a buy call, we become a buy side, like buy call or sell call. If we become the buyer, buy call, we have the right to buy a house from the seller at an agreed price. Let's say here is 700,000, and then for the seller, they have the obligations to sell the house to the buyer at an agreed price, 700,000. What it means by this? So when we become a buyer of the call, we hope that the price will goes up, so that we have the right to buy at 700,000. So we will pay the premium. So we will pay the premium. The premium will be, let's say it's $500. So we will pay the premium to the seller in hope that we can buy the house at 700,000. Like maybe let's say the expiry date is 3 months, that we can buy the house at 700,000 3 months later. So if the price went up after 3 months, let's say 800,000, now the market price is 800,000 after 3 months. However, because of this contract, we can buy the house with 700,000. It means that from 700,000 to 800,000, we actually earns 100,000. Minus the $500 deposits, we can earn 99,500. So for the seller, they will receive the deposits. In options we call premium. So the max gain is the deposits only. So the seller actually will suffer a lot of losses if the price goes up in buy call. So if the buyer want to exercise the contracts, they have the right to buy the house at 700,000. If they want to sell, buy the house at 700,000, so the seller actually have obligations to sell it at 700,000. So now let's say the house price goes up to 800,000 after 3 months. Let's say expiry date is 3 months. So the seller have to sell the house at loss, because now the market price is 800,000, but he has to sell it at 700,000. This is called buy call in options. So if you become the seller, you actually just receive the initial deposit, and your maximum return will be only the deposit, which is the premium. All right. So, but in this case, the seller lose a lot, right? But later I will share with you all how can we earn as a seller. Because actually if you become a seller, you actually earn a lot. You have a higher winning rate. And Warren Buffett likes to become a seller in option trading. So, in summary, for buyers in call options, the buyers has the right to buy. What it means has the right to buy? It means just now the buyer can buy the house at 700,000, right? So what if the price drops below 600,000? Now the market price is 600,000, but in the contracts you have to buy at 700,000. So no one will be that stupid to buy the house price at the higher price, right? So the buyers has the right not to buy it from the seller, and then the seller will just get the deposits, and yeah, you will just get all the deposits. And when the buyer want to sell, the seller has the obligations. When the buyers want to buy, the sellers has the obligations to sell. So in this case, we will focus on seller today. So what it means by seller, maybe for if you are new in option trading, maybe it can be still quite complicated. I understand because I had been go through that stage. However, today I will give you all a very simple idea on how to get this idea in call selling, in sell call. It means that in sell call, the call seller has the obligations to sell. So you can see it as the call seller has the stock on hand, right? The house is a stock. Then when it hit the strike price, it has the obligations to sell. It means call sell. It means take profits, because as a seller you got the stocks on hand, and then you have to sell to the buyers, right? If the option is exercised. So you all just think like that. As a call seller, you basically are taking profits if you got stocks on hand. Like you got house on hand. Like if you buy the house at 500,000, then you sell it at 700,000. Did you lose in this trade? No, you still earn 200,000, right? But just now we said if you agree to buy at 700,000, but if the price goes up to 800,000, maybe we'll lose another 100,000. However, you did bought the stocks at 500,000, so actually total you still earn. So you just, as a summary, you just think that if you become the call seller, you actually just take the profits from your stocks. You just sell your stocks, provided that you got your stocks on hand. If you don't have stocks on hand, you will incur a lot of losses. So to be short, you just remember that if you become a call seller, you just basically take profits from your previous stocks on hand. The idea is you must have stocks on hand, and then if you do become a call seller, you can get the premium, you can earn the premium, and then if it hits certain price, then you will sell. If it hit a certain strike price, you will sell your stocks to other buyers. So you basically just get this idea, like become a call seller. Actually, you just take profit of your existing stocks on hand. Just remember this first. I will give more examples. So for puts is the other side, is opposites of the call. If we become a buy put, we can become a put buyer. Actually, we want the house price to drop, and then we have the right to sell. We can decide to sell or not. So if the price, and then the developer, which is the seller, will receive a certain deposits, like the premium. Let's say here is $1,000 as a premium. So if the price drops from 500,000 to 600,000, actually you can buy back at, now the market price is 600,000, but you can sell it at 700,000. So it means that you earn 100,000, and then minus the $1,000 deposit you give to the seller, you can get 99,000 profits. And then if you want to sell, you can decide to not to sell a house, because you can decide not to exercise the options, because when the price is going up, because when the price from 700,000 goes up to 800,000, why will you sell the price at 700,000? Outside is market price is 800,000. I might as well sell it at market price, and then just lose the deposits in this case. All right. So when the buyers want to exercise the right, the put seller have the obligations to buy the house from the owner at an agreed price. And then if you buy the house, it means in the stocks, it means it buy the stocks. So just now I said that call seller, you just remember call seller actually is take profits, because you got existing stocks on hand and then you want to sell. And then for the put, you have to have enough cash to buy the stocks from other people when it hits certain strike price. If not, you will get the premium, you will receive the premium. So the idea of become the seller will be, you receive, as a seller, you always receive the premium first, the deposits, the premium first. And then in call seller, you are taking profits. You must have, but first of all, you must have stocks on hand, so that you won't incur huge losses. And then for the put seller, you must have enough funds to buy the stocks, which is the buy limits. One is buy limits, and then one is take profits. So I will give a more in-depth examples. So for let you all know what exactly it means, because sometimes the theory can be still very confusing. So you all just remember again, call selling, sell call, become a seller, both sell call and sell puts, you receive the premium. And then sell call basically is sell your stocks at a certain price, means take profits. You just remember sell call equals to take profits. And then sell put equals to buy limit. You want to buy a stocks at a certain price. And then sell call will be you want to sell a stocks at a certain price. So in sell call, if you want to sell a stocks at a certain price, you need to have stocks on hand, existing stocks on hand. However, if you want to sell puts, you must have enough cash to buy the stocks. So you have to prepare enough cash. So again, sell call equals to take profits, sell put equals to buy limits. So, and both of them is can get a premium. Maximum earns profits will be the premium. So this is a summary. In buy, on the left side is the buy call and buy as a buyer in options, buy call and buy puts. So the call buyer has the right to buy, the put buyer has the right to sell. And then we are focused on the seller today. So car sellers has the obligations to sell. It means take profits. You got stocks on hand. You want to sell it to the buyer. And then for the put seller has obligations to buy. So you want to wait the price, you want to buy the price, so you have to have enough money to buy the stocks, because one contract equals to 100 shares. So again, let us go through what is let us focus on what is option sellers. So the option sellers is the ones who fulfills the promise. The pros, it gets a paid upfront. It means once you become a seller, once there is a buyer that opens a contract with you, then you will get the premium. So you will get paid upfront. The cons will be more money reserved or assets required. You need a lot of stocks on hand, and you need a lot of cash on hand. So because one contract equals to 100 shares, so you need quite amount of money in option selling. So how does it reflect on options? Call. So let us give an examples in option trading. So let's say this asset is ABC, and then the expiry date will be 2024, 12/30, and then the strike price will be 105. Call. Then if we become the call buyer, we have the right to buy 100 shares of ABC before 30th of December at 105. And then today we will focus on become seller. Then seller has the obligations to sell 100 shares of ABC when exercised at 105. So the buyer will pay this, let's say this premium is $2. So one contract is 100 shares. You have to pay 2 times 100 equals to 200. So if the option contract is made, the buyer has to give $200 here premium to the seller. So if you become the seller, you'll directly get this $200. Alright, so once you become, your maximum gain as a seller will be receive those deposits. So when to execute? So in this case, you can see that just now I mentioned in sell call, you are basically take profits. If you become a seller, you basically take profit because you sell your stocks. So in this case, if it rises to 105, which is the strike price, you as a seller have to sell your stocks. So at the same time, same as is the opposite as the put buyer or put seller. So this here, the strike price will be 95. So the buyer has the right to sell. In this case, the put buyer has the right to sell the 100 shares of ABCs at December 30th at $95 strike price. So the premium is same $2, and then as a seller, we will directly receive $200. First, however, if we hit the strike price, just now remember, become the put seller, we actually is put a take profits limit. The strike price is the take not the profit limit. The strike price is the buy limit. So you just remember, the strike price will be take profits level of call seller, and for put seller, the strike price will be the buy limit. Because you have the obligations to buy 100 shares of ABCs when exercised at $95. So if the price hit below $95, you have to what? You have to buy. You have the obligations to buy 100 shares at $95. You have to buy the stocks when it hit below 95. Alright. So again, like for summary, for call, if it rises to, for sell call, if it rises to above 105, which is the strike price of the buy call of the call options, it must be sold. And then you paid the you get the $200 premium. You sell high, which is take profits. And then for the put, if drop below this, drop to 95 or below 95, you must buy back at 95. It means you must buy the stocks at 95. So it means that you buy low, buy limit. You can just understand it at buy limits. Sell call, take profits. Sell puts, buy limits. You just remember all this because this is just that simple. If you all got any questions, maybe you can can just remember to put out in the chat. Can we cancel sell puts before? Can we cancel sell puts before expiry? Before how long? Yeah. Actually, we can directly just close our sell puts. You can. But it depends. But it depends because it depends on the price of that time. Yeah, the time of that time. So for covered for just now the ideas is I will just repeat, if you all don't really like, maybe some of you all feel the theory is very complicated. So for for buyers, actually our maximum loss in buy call or buy put is the premium only. Let's say just now the premium is $2, we only make, and then one contract is $100, we actually just lose $200. All right, and then the risk is minimal. However, if you do a naked sell, what is naked sell? Naked sell is like you do a sell call, right? Just now sell call is, I mean, you take profits. However, you take profits, you must have stocks on hand. So if you don't have stocks on hand, you incur a lot of loss, right? Because you don't have stocks on hand, and then when the price hit at that high, you will incur a lot of stocks. Your loss is unlimited. So that one is naked sell. However, we must not do naked sell. This, when you have stocks on hand, we call it covered call. You got stocks on hand to sell. And then for the sell call is basically a buy limit. You must have enough cash to buy at the strike price, because if you don't have enough cash to buy at the strike price, you will incur a lot of losses. All right. So basically, you can the famous strategies will be, when you got stocks on hand, you can do a wheel strategies. We'll start it by buying the stock first. Like we prepare enough of cash. Like let's say later we'll give more examples. So we will just, because it is covered call, sell covered call is called take profits, and then sell cash secured puts. Cash secured put is mean you got enough cash to buy the put, the sell to buy the stocks in the sell puts. So it means that once you buy the stocks, then you sell call. You sell put first, you get the stock, you buy the stock, you have enough cash to buy the stocks, then you put the sell call. And then you can keep on earn premium. So let us give some case study. Let us do some case study. All right. So let's say this is wheel strategy. How we start with a wheel strategy. Now you have enough cash. You want to buy a certain stocks. Let's say now this is GLD, one of the gold ETF. Then you determine the area you wanted to buy. In this case is 236. Sorry. I think 236 and 229, around 230. So basically, this is the point maybe I'm interested in. It depends on you where you wanted to buy. Then we'll check it on our uSMART trade apps, to see the strike price and the premium. To check the strike price. Let's say you want to buy at 236. This is a strike price. Then the bottom one is 229, maybe 230. Let us see. Then when we choose the options, then one is 229, one is 236. One of the the nearest support will be 236. So the strike price will be 236 and the premium is 2.33. Then the further support will be 229, which is 0.97. So in this case, we can see that the nearest support has a higher premium. So if you become a buyers, you don't want high premium, right? You try to avoid paying high premium because in the money. However, in this, if you become a sell side, we want to earn the premium while waiting the price to. Since we want to buy, let's say I wanted to buy this gold, then I decided to buy this gold at 236. So once I sell a put, once I sell the puts at 236, I decided, let's say I wanted to buy this GLD gold ETF and I wanted to buy at 236. Other than directly buy on spot, we can directly sell this option 236. Once you open these sell options, you become a sell put. You open a sell put. While waiting it to buy at 236, buy limit, it is a buy limit. While waiting it to buy at 236, you get an extra 2.33 premium times at least 100 shares. So 2.33 times 100 is 233. However, remember, remember 236 times 100, because 100 shares, you need to prepare 2,036,000. No, not 2,000, $23,600. You have to prepare this amount to buy limits at the price. And then once you sell these options, you will get to earn this 2.33 premium, 233. What is the best time frame for expiry? I will advise not too close. Maybe for me, I will just suggest 1 month, because to avoid a lot of volatility, to avoid a lot of frequent because the nearest actually the premium is not that much already, because the time decay is a lot in the last 1 month. So we try to sell the options, I think, above 1 month, because the last 1 month time decay fall very fast, so the premium you can earn is very low. So it's better you maybe 1 month to 2 months and above. It depends on your appetite, on your risk appetite. So my suggestion is not too close, so to avoid we do too much trading, because sometimes you do too much trading and then actually you can earn but not that much. So it's not advisable to do like maybe less than 1 month. This is my personal experience. You have to try yourself to understand the ideas behind why this and why that. All right. So I want to buy this GLD ETF at 236. Other than put a buy limit at a normal stocks, I can go to options and then I sell a put at strike price 236. Then I will directly get, while waiting it hits 236 dollars to get the stocks, to buy the stock, I can get 233 dollars premium. This is extra money. So this is how Warren Buffett like to do, because since he wanted to buy a certain stock at a certain price, he will just open the sell. If you want to buy the stock, he will open the sell puts and then wait it here while earning the extra money. So what happens if it does not exercise? If the sell puts does not hit 236 or below, so you will get a total $233. However, if it hits this it hits below 236 and below, you have to buy the stocks at 236. So in this case, you have to buy you have to buy 100 shares, and you get this extra 233 premium. All right. So the idea is you want to buy at this price. While waiting it hits. If it didn't hit, like if it above this 236, if it didn't hit, you will continue to sell this. You will keep on sell this puts. Then you continue to get 233. However, if it hits this 236, you already receive this. Once you open the sell, you will directly receive this premium. Then you will buy it at $236. It's that simple. So just now I said sell cash secure puts is buy limits. So now after we sell puts and then we get the stocks, now we got stocks on hand. So now we can do sell call. What it means by sell call, take profits. As I said, sell call is take profits. So in this case, like if I wanted to sell it at 251, and then the premium, and then the premium is 0.82. The premium is 0.82. So what happens? If it didn't hit 251, I will continue to get this 0.82, and then after maybe expiry date, I will continue to sell another call. However, if one day the price, while we sell the call, if it hit 251 and above, we will sell our stocks on hand, 100 stocks on hand. So the premium will be $82 because it's 100 shares plus 100 shares sold. So just now we already buy it at 236, right? So then we sell call, and then it hit our TP, take profits limit, is 251. So we actually earned how much? 251 minus 236. This is the stock price we earn. So it's roughly 1,000. Because it's 100 shares, so we earn 1,500 from 236 100 shares to 251 100 shares, and then we earn the premium. The previous premium, when we do sell puts, is 233. We get the 233 premium, and then plus this sell call premium, $82. Total 312. So we will get this. We will get 1812. So this is how we do wheel strategies. If you want to buy a stock, we do a sell puts first. We prepare enough of cash to buy 100 shares. We buy the sell puts first, while waiting it to drop to hit. If it didn't hit, we'll keep on selling the same contracts. Then if it hits, we'll buy the stocks. Now we got the stocks and get the premium already. Then we open another sell call where we intended to sell. While waiting it to hit limits, we will keep on sell the call to get the premium. All right. So this is how Warren Buffett's famous strategies is do this wheel strategy. Warren Buffett earned a lot in options. So while waiting the price to hit certain price, why not you do extra money? You get this extra money. So this is an idea why many doing sell got a lot of success rate, has a higher success rate. So you basically just keep on buy sell, depends on your trading plans. So in summary, for these wheel strategies, sell puts is buy low, and then sell cover call is sell high. If the option is not exercised for the sell put is buy limit, sell call is take profits. Then you have to cash secure puts, means you have to prepare money to do a sell put first to while waiting it to hit your buy limits. You don't have stock on hand. While waiting it to hit the buy limits, you get extra premium. When it hits, you have to take your cash to buy 100 shares. Then now you got shares on hand. Then you can sell call. Sell call is where the price you want to sell. Then while waiting it to hit your TP, take profits levels, you can earn the premium. Then you will keep on repeat. This is what we call wheel strategy. So this is the sharing sessions about the sell side, how we can earn passive income by becoming a call seller. So if you all have any questions, please let me know. I'll try to answer since now still got quite a time. We can keep repeating until it touches our buy line. Yes, let's say you sell. Let's say you want to buy at just now like $200. Let's say you want to buy at $200. You can sell. Let's say you sell 1 month. Sell puts. So in this 1 month after expired, it still didn't hit your buy limit. You can sell another. After 1 month, you can sell another puts. Alright, until it hits your buy limit. And then since you intended to buy at that price long ago, so when it hits the strike price, your buy limit, it hits, you get the premium, and then you got stocks on hand already. Then you try to sell call. You want to sell at the intended price, but while waiting it to hit your limit, you can sell call to get the premium, and then you keep on repeats. So this is called a wheel strategies. So this is better to use on those stocks that you wanted to for long term and have a very confidence to buy. Because sometimes when the price drops, you hit the buy limits, right? It still can drop, right? You have to have an idea that these stocks you wanted to buy at this price, and then you wanted to hold it for a long run. So you can keep on do this to churn a lot of extra money, passive income. So it depends on your strategies. So we can keep on buy, sell puts, sell call, sell puts, sell call, sell puts, sell calls, and then we all keep on repeats. It depends on your strategies, but my advice is better choose those long-term, your confidence stocks to do these strategies. All right. So anyone have any questions? Okay. So yeah. So I will keep on. Why I keep repeating, because sometime last time I used to be a very newbie. I'm very confused about the buy or sell. So I come up with this idea that you just remember that sell call, we don't do naked sell call. Sell call is take profits. So sell puts with enough cash secured puts is buy limit. You just remember this idea, and then as a seller, we always earn the premium first. We always accept the premium from the buyer. All right, then we buy, we got stocks, then we sell while waiting it hit the TP, and then we buy at low while waiting it to hit our buy limit. We get the premium, then we will keep on milk these extra profits out of the markets. All right, so this is the idea of call seller. Yeah, it has a higher winning. To be honest, it has a higher winning rate compared to normal one, buy side. But it really depends on your strategies. So if you all have any questions regarding to the apps, you all can look at your apps and then look at the prestige service, or maybe find customer service. Everyone have a designated customer managers. So yeah, just to inform you all, if you all face any questions about uSMART, you all can ask this go for customer support or customer service manager. And then for those who has WeChat, you can consider to add my WeCom, or maybe add our just newly opened telegrams. But this telegram, not much people there yet, so we just see if there is enough people. Maybe we will share more in the telegrams. Yeah, thanks for the support. So before I end this, any more questions? So if you all don't have any much questions, lastly will be this disclaimer. So I do hope you all learned something new today. And then maybe for starter, it's still very complicated. But I do hope that you all can try it. Maybe start little by little. All right. So even from like basics trading, all this stuff, we all have to get to started from somewhere else. And then I do hope these uSMART sharing sessions can benefit you all and can wish may the markets be with us, not with you all, be with us. So thanks for the support and see you all next week. Bye. Bye.